Good evening. I'm John Batchelor. This is the John Batchelor Show. Gordon Chang, Forbes.com contributor, joins me. He's in Hong Kong. Later on this evening, I will speak to several voices about the crisis in the Middle East, the Russian adventure, the Russian intervention in the Syrian war, and what this means in conflict terms of the new Cold War. In Washington now, I'm told, especially the uniforms, are discussing the Russian military in a fashion I've not heard since the 1980s and 1990s. That is, what would a conflict look like between the United States and Russia? What would Moscow and Washington do in the event of a hot war, not a cold war? We're looking at the capabilities of the Russian military, both regionally and globally. Same for the United States. The Syrian civil war is one theater. Ukraine's civil war is another theater. Certainly along the Russian frontier, NATO is alarmed by Russian challenges and military exercises, the Baltic states. So I'll discuss that later in the program. Right now, we're going to look at China because the visit of President Xi Jinping within these last weeks underlined the disappointment in China over this last year or two. Not only a disappointment because of the cyber espionage not solved, to my understanding, between the United States and China, the theft of intellectual property rights, the purloining of vital information of the U.S. government, the OPM stolen fingerprints having to do with national security of the United States. None of that was resolved, but the larger story is the Chinese economy. And it would be a more burning matter if the Chinese economy was not now behind a curtain, a very large curtain of debt. It's non-transparent. No one, to my knowledge, is any longer quoting a Chinese government number about any of the important economic metrics. We've celebrated these last 20, 25 years of the Chinese miracle. Gordon, a very good evening to you, and we go immediately to our colleague Anne Stevenson-Yang, who has published a research paper most recently about China going into the future. Anne is co-founder of J Capital Research in Beijing, author of China Alone, The Emergence from and Potential Return to Isolation. Anne, a very good evening to you. You headline that China's economy could, may be shrinking by a third in U.S. dollars in the immediate future. And you write that the accelerating driver of this shrinkage is debt. How does it work, Anne? Very good evening to you.
Hi, John. Well, I mean, think of it this way. If you borrow $1,000 to build something, then while you're building it, then you're creating GDP. You're employing people, you're buying steel, you're putting things up. And then if that building sits empty, then you have to keep it clean, you have to keep it lighted, you have to have some heat. If it's in the north, you have to have some water, and plus you have to pay your debt. So borrowing the money accelerates your GDP on the way up, and having the excess capacity accelerates the decline of your GDP on the way down.
Gordon?
And in your October 5 research note that John referred to, which, by the way, everybody should read because it will challenge people's notions about the Chinese economy. In your October 5 note, you mentioned that there is the possibility, even the probability, that China will de-link itself from the rest of the world. We've already started to see this in the money funds area where credit cards can no longer be used to take money out of China in the amounts that once were permitted. We've seen all sorts of attempts by the central bank to limit futures trading. What's going on here, and why is this de-linkage so important?
Well, in an economic sense, what it means is that over time, and I don't think it'll happen immediately, but China has acquired a huge amount of debt. Just since 2008, China has made as many loans as in the whole U.S. Banking system, and that banking system has been built up over 150 years. So that was just the additional debt acquired since 2008. So imagine that. So, there's really no way to resolve all of this. You would need to have the GDP, just to service the debt, you'd need to have the GDP growing at about 20% per year, and that just can't happen. So the way for China to resolve this issue ultimately is to inflate the debt until it just becomes cheaper and cheaper by adding more and more currency within China. And to do that, it has to sort of cut itself off from the U.S. dollar. So that means closing the economy more.
What does
it's interesting. I listened to Larry Summers on Bloomberg Go this morning, and he had this statistic which just was incredible. He was saying that between 2011 and 2013, China poured as much concrete as the United States did in the entire 20th century. So really, that's an illustration of what you're talking about.
Yeah, that's right. China is full of statistics like that. You know, stack up all the renminbi notes and they lead to the moon and back and things like that. I mean, it's just, the size is always very stunning.
And you have a note inside the note about commodities, that the Chinese demand drove commodities, and we now see that commodities are in a sharp decline, and they could decline more. Question of demand. What is this? How does this connect to delinking? Does that mean that the Chinese are never coming back and that we've got to adjust the commodity prices with that in mind?
Well, yeah, I mean, and I think that if we were to clear out Chinese demand, the incremental Chinese demand that's come on since 2008, we're going to find out that actually international demand for energy and commodities has not really grown much since 2007, and all the growth was provided by China. Now that growth is going away, and we're going to see historical lows for commodity prices, and that won't hurt the United States so much. It'll be very painful for exporters of commodities like Brazil and Australia and Canada.
Well, Gordon and I had a conversation with Professor Evan Ellis of the War College just a little while ago, Gordon. We were speaking to that, and that China made these large loans into Latin America, the resource-rich Latin America, and its expectation of being paid back was based upon the idea that the countries would prosper and that commodity prices would maintain or grow over these next years. Gordon, what Ann is saying is that not only is China in trouble, all those countries that depended upon China are in trouble.
Well, certainly. You know, when you have countries in Latin America, would be Brazil and Chile, and in Asia you have Australia. All of these countries have been exporting commodities to China, and they built their economies on the assumption that this demand for commodities would continue indefinitely. And what we have seen over the last 2 years is the end of the commodity supercycle. And these countries are now suffering because they have not been able to diversify their customer base, and China is not buying commodities in the amounts that people expected. So this is really changing not only the global economy, but eventually it'll change geopolitics as well.
Speculation, Ann. In the United States, when a state goes into a decline, people vote with their feet. For example, Californians move to Texas. Is that possible as a way to remedy this decline in China, that people will vote with their feet and leave?
Really, that's already happening. There was recently a survey that found that something like 40% of China's high net worth individuals are planning to leave or want to leave China. The capital flight indicates how people want to move now because things are not as good as they used to be. But I guess that my point in writing this commentary was to point out that a slower growing world and a declining Chinese economy, it isn't all bad. There was lots of bad stuff that occurred as a result of China's excess, GDP growth on steroids, and a lot of those effects are going to reverse. And I think on balance, it's going to be a healthier situation for the world.
And Stevenson-Yang is co-founder of J Capital Research in Beijing. I thank her for that sunny note at the end. Gordon, it certainly doesn't look like promising in the immediate future because this is not in the market prices yet, correct?
That's correct. But, you know, the United States is deep and resilient and will sort of end up much stronger on a relative basis than we are now.
Gordon Chang, a Forbes.com contributor. He's traveling. He's in Hong Kong. I'm John Batchelor.